So thank you everybody for listening to another episode of Simply Finance with Shane White. I am excited today to have Scott Bennett on the podcast. Scott is now an entrepreneur, but also worked in the finance field for a long time, and I'm pumped to have him on. So Scott, thanks for joining.
Hey, Shane, thanks so much. Really happy to be here and excited.
Yeah, absolutely. Would you mind giving everyone just a little intro to yourself and a little bit about your background?
Yeah, so again, my name's Scott Bennett, originally from Massachusetts, and currently live in Denver with my wife, my young son, and a dog. And well, we've been here just for collectively on and off for a little over a decade. Denver's a great place to live.
Oh, yeah.
For a little over 16 years, I worked for one of the largest asset management firms in the world, Fidelity Investments. It was an incredible experience. I learned a lot. And like many people this year, it's been a really challenging year to say the least. I went through a family challenge where if anyone else has gone through my unfortunately we lost my mother, not to
Oh,
COVID, but
sorry.
to metastasized lung cancer. So it was a lot, and I really valued our time together, and I really wanted at the end of her battle to be with her. So I made a tough decision, but it was I know it was the right one. So I ran out of time, and it was time for me and my family just to spend as much time with my mother as possible.
Yeah.
And that was a great experience just to be with her. And then from there, it was kind of saying, okay, what's my next chapter and what's the
Right.
next step? And after all those years at Fidelity, I've developed a couple of interesting concepts. My biggest takeaway was I personally had a problem for years. My friends, my family, a lot of people that I was talking to, and I'd say the biggest thing that their biggest struggle was that they were really investing without confidence. And when the market's going up, like it feels like right at this moment, that usually means you underperform a little bit. You're not making as much. You kind of have these like, oh gosh, I should have bought that feeling. You're always kind of like, well, why didn't I see that one coming?
Sure.
When
Yeah.
the market's going down, like in March and February timeframe, a lot of people panic. And really what today, my role, I run a website called investwithrules.com. And the mission there is to help people invest with more confidence in less than 5 minutes per week. And we do that by helping people buy with more clarity, sell with less worry, and invest with confidence. So that is the mission. We'll go through more of that later.
Awesome. That sounds exciting. I mean, and I'm sorry to hear about your mom. I'm glad you get to spend
Thank you.
time. That's at least one, silver lining, I guess, that you get to spend some quality time. You never know when the end's coming, but if you got to spend time at the end, that's fantastic.
Yeah, thank you for that. I appreciate it.
Yeah. So maybe I'll start I think it'd be really interesting because a lot of my audience definitely is here because of like investing, personal finance. Would you mind kind of giving everyone just a little bit of a rundown of what it was like working at Fidelity? And really the purpose of my question here is just, I have a lot of young listeners, I would say like in the mid to late 20s, even some like early 20s, that probably have never worked with anyone from like a Fidelity or any like wealth management type of service before. So maybe just to give someone an overview of like what you can expect by working with like a Fidelity partner.
Yeah, I would say it depends on what you're looking for. But I would say generally Fidelity is an open architecture brokerage firm where if you wanted to invest in any, let's say, stocks, bonds, it's just really easy. Their website's outstanding. It's very user friendly. So when it comes to either online or on your phone, the experience is excellent. So I've had a lot of clients that have been with Fidelity for decades, and even some of I loved when I used to get referrals. For most people, it was for years I would get referred to, like, it's funny, at the end it was like grandchildren, and
Okay. Yeah.
it was like, it was great. I was like, oh my gosh, you're so far ahead of other people because you're starting now. That's what
Sure. Okay.
starting soon and starting now is so important. So Fidelity, so number one would be just a great website and easy to use. And number two, they do have an awful lot of financial planning tools just to see if you're on track. And I think a little of that's hard because when you're saying, oh, I'm going to retire in 2060 or some odd
Yeah.
number,
Right.
and it
So
looks so far away, it's a little daunting to say, like, how do I do it? But it is really nice to have someone look over your shoulder and just say, yeah, you're doing the right things, you're saving the right way, you're on track. So part of my role was the certified financial planner for all those years and saying, yes, you're on track. And
Okay.
then, and then kind of being a little of the jack of all trades.
Got it. Got it. And then how, just like as a synopsis, how normally, like, what are some of the key things that people, or you would notice that would tell you if someone's on track or not? Because I think that's an interesting thing, and depending on who you talk to, it could be different.
It's really interesting. So software is created by very smart software engineers.
Sure.
So I mean, primarily a lot of it is just inputs and outputs. So it's just looking at your current cash flow. Um, I'll give you both sides of it. So I've seen a lot of people who max out their 401k. That's usually the traditional advice. Max out your IRAs, your individual retirement accounts. And by doing that, it's first off, that's really hard because
Yeah.
living in a city or living in an expensive place, living within your means is really, really hard. So just getting someone to, at least at the bare minimum, if you work for a company, and they offer you a match, they're offering you these incentives to save for your retirement. Sometimes people just need the encouragement, but that's the right move for the long term.
Okay.
The What I've noticed is I worked with, for call it the last decade of my 16 years there, I worked with primarily $1 million clients. And what I've noticed is they had these huge 401k IRAs, and they typically had really small non-retirement accounts. And
Okay.
what that meant is for most people, they're fine. No big deal, not a big problem. But for a lot of people, they said, you know what, I've saved really well. I've worked really hard and I've sacrificed, and I want to retire a little bit early,
Yeah.
and they can't. So,
Got it.
so, so
Sorry, and to back it up a little bit. So when you say that, you mean like someone has a really nice 401k, a Roth or an IRA, but then maybe like their actual savings checking accounts or, fund investment accounts, whatever, are small. Is that kind of what you're saying?
exactly right.
Okay.
And typically you have to wait till 59 and a half. And there's always loopholes in financial planning and tax code. But to make it really simple, is some people, they tend to just, they don't have a little bit of the balance. And I think balance is important. Whether maybe one day someone aspires to be an entrepreneur, that money you really can't touch.
Right.
Or if you
Yeah.
do, it's a huge penalty. It's really designed, incentivized for you to wait, which is, we know the right thing, but
Yeah.
sometimes our life changes.
Well, yeah, I mean, you're a
So
good example, right? Like if you have if you're someone who didn't have any savings and you've done a great job of putting it into your 401k or IRA, and then you want to start a business, yeah, you don't have any money, then that's a challenge, right?
yeah, most people don't really want to borrow from friends and family,
Right.
and you got to pay the bills.
Yeah.
So, and then the question is, how much of a lag time or lead time do you have before you really can be stable? So,
Right. Okay.
it's an interesting. So there's two sides of the coin. I would say the traditional side is usually right in most people's cases. Most people are excellent workers. They're excellent. I don't love the word, but entrepreneurs, where they can kind of maybe run a division of a business or do something incredible.
Sure.
But if you really want to run your own thing, you got to be thoughtful. And I think that's where it's good to have someone look over your shoulder once in a while.
Got it. Okay. Okay. So again, there's not like a right or wrong. It's all kind of about your life plan and kind of what you need in order to optimize whatever angle or whatever direction you're heading in, right?
I completely agree. I always say, like, there's the textbook version, and
Sure.
then here's what applies to based on what you said. So
Yeah.
I think so. When one of your listeners sits down with a financial planner, it's so easy just to get bogged down in the numbers and the cash flow. But having a financial planner ask you the really good and the tough questions about what you want out of life, and what your life it's hard to say at that age, but what you may want your designed life to look like.
Right.
And that's a really good financial planner who can kind of piece it all together for you, because
Okay.
that's what's going to get you where you want to go.
And I would assume too, and tell me if I'm wrong, because I've talked to a lot of financial planners, but I don't actually work with one directly right now. I would assume, you develop like a life plan, but then like everyone's life, things happen and things change. Would you say like a good financial planner, someone who I'm assuming they can like kind of change your direction and change your goal as your life goals change. And so it's like a moving project all the time, kind of, right? It's like probably a macro direction, but some micro changes depending on what's happening, maybe.
I would agree. And I think there's such great software that's now kind of two-side users. So the the planner and the person who's using the software can use it together. Just because, I don't know, I remember when I first started, like what a good financial plan was like a 50-page document with like a bow on top. And the second the client leaves the office, it's old, it's stale,
Oh,
life
right.
changes.
Yeah.
Um, Someone has a kid and it's like, well, oh my goodness, that's 12 different things that we didn't talk about last meeting. So,
Sure.
it has to change constantly.
Yeah. Okay. That makes sense. That makes sense. Um, was there any like anything major you could say was a takeaway from being at, Fidelity and being in that line of work for a long time of like something to avoid, like completely avoid and not do? I always love to hear those kind of stories.
Um, that's a really good question. Avoid not to do. Um, I would say as so let's take as an investor. Um, I think if you wing it, um, if you if you kind of if you just simply watched financial media and you just
Okay.
wing it, I think you're going to be in a real heap of trouble. And I had a really funny conversation with my father just a few days ago, and we were having these conversations. He's like, I think the conversation was, they have a vaccine. Why aren't those stocks doing better? Well,
Okay.
and my explanation, I hope this makes sense, is,
Yeah.
well, those stocks are already up 200% or 300%. So the market loves to be 6 months to a year out in its thought process.
Mm-hmm.
And the moment the news hits, people are always, their initial reaction is, oh, that should do great today. Well, it already did. So the
Yes.
question then, what you have to train your brain to think is, okay, well, what's the next reaction, or what's the next step that's going to come? So in this case, vaccine meant, again, no one knows the future, but maybe 6 months, maybe 12 months, maybe 24 months, people are going to get on cruises again. People are going to get back on an airplane and feel better that there's someone in the middle seat. So it was the people are probably going to use oil again or
Okay.
energy.
Yeah.
So it's the double jump
Right.
where but what you shouldn't do, you shouldn't probably trade on immediate news. You're probably going to
Okay.
lose. You
Yeah.
probably shouldn't be day trading. I think that's for most people, not successful.
Yeah.
And I think that you have to have, and I know obviously my business is called Invest with Rules. You have to have a process in which you'll follow. No different than when a pilot gets on the plane. No different than when an athlete gets on the field. You're prepared.
Okay.
If you're not prepared and you wing it, sadly, it's the most exciting game in the world if you're trading or investing. Someone's on the other side of the trade who would love to take your money. So if you're
Yeah.
making constant mistakes, they're they're taking your money, and it's unfair, and it's not the way it should be.
Got it. Okay. Yeah, that's a funny way. I mean, that's if you really get down to how a trade works, that's exactly right. Like if you're selling or buying something, someone's on the other end buying or selling as well, which is so interesting in that context to think about. I guess that's a good way to think back to the initial, like the crazy dip we saw in the market when COVID hit then, right? Too, because kind of go off what you said, it was as things started closing down, that was pessimism and everyone worried and knowing that all these industries were going to just like collapse with no one leaving home, right? So that's again, it was not necessarily because someone in the U.S. got COVID. Is that a direct correlation to the reason a stock's going to fall? But everyone's trading, they're thinking ahead to the next 6 months, like you said.
Yeah, and I'll get into my process, but I mean, a logical thing for someone who's thinking 6 months to a year out is saying, you know what, no one's going to be flying for a short period of time, maybe a long period of time. No one really wants to be in hotels. That's not their own
Right.
home. Um, we're not going to drive as much. So there's a whole chain effect of what causes that kind of that scare, that panic, that pessimism.
Right.
And the moment, most of the time, I guess the main crux of why I started what I did is I can't communicate with my old clients for a long time, for a
Sure.
year and
I'm
change.
sure. Yeah.
And I just know that because I have friends that did it, which means that I have old clients that did it, and I care about these people a lot. And I know for a fact that they're probably selling at the worst point. And my hope is that my free letter that I send out once a week is good or better than some of the paid ones that exist
Oh,
for
okay.
investment newsletters. So
Yeah.
my hope is that if someone very simply is just kind of getting that itch, like, oh my goodness, like, should I start selling off? Or the answer to most to the model, which I'll get into later, is now, I don't think you should be kind of doing these drastic in and out moves, but our brains love to trick us. So as an example, at the end of February, I have a model that it was built, which is an interesting story, but based on it's a little bit based on relative strength and price trend. And relative strength just means are things getting stronger or weaker?
Okay.
And
Yeah.
the model tipped me off at the end of February and just said, hey, something I don't know, but something doesn't look right. And did it know that there was kind of an ever spread of coronavirus overseas? And the answer is it has no idea. But something in the price movement, in the relative strength movement, just showed something was off.
Hmm.
And it tipped me off to say, you know what, if this is not the time to buy. This is the time to take any positions that you're not in love with, or you don't have large gains, and just play a little defense. In a retirement account, there's no taxes. In a non-retirement account, again, we're not taking a huge tax impact. And then I got an alert again in April, and it said, I doesn't know the coast is clear, but it said something just seems maybe the worst is behind us.
Okay.
Someone with large money is buying. The prices are moving up. The strength is kind of coming back. But my fear is if we go based on our gut, our wing it feeling, then you're selling in March and you've
Yeah.
just got knocked by a third of your portfolio is gone and you sold at the worst point. And my hope for free is if someone just read the weekly newsletter at the bottom, it's like, oh, bad timing. Don't do it.
Got it. Okay. Yeah. I mean, I've been very openly public on this podcast about that. I was one of those people that I just wanted a slightly better cash position just because it seemed like this was a once in a lifetime situation potentially. So I sold off a decent amount of our portfolio, and yeah, it was a good lesson learned. Like I'm 29, I've done that, and I'm hoping I don't ever do that again. So lessons learned. But let's jump into that because so for everyone listening, Scott obviously worked at Fidelity for a long time, and as he's been alluding to, left, started his own business. So, Scott, do you want to kind of just give everyone a download into what you started, what it's called, and you've alluded to it a little bit, but then give everyone just a little bit of a background into what it is?
Yes. So it's called Invest with Rules, investwithrules.com. And I deliver two things. And I'll kind of go through the backstory. But the very first item is I'll start with 2008, which is a much worse version of what we just saw in March.
Okay,
So
right.
I have excellent experience with Fidelity. I would highly recommend working there. It is an excellent place to start and to have a great career. I could have easily seen myself there for my entire career, but things change. And in 2008, whether you're at Fidelity or any other firm, if you're working in financial services, it is an awful experience, just possibly the worst experience you could ever have, because I was in my mid to late 20s and I had multi-million dollar clients looking at me for confidence. And I'm relying on the behemoth of my company. But the truth is the market was down by, at one point for a short period of time, 50%.
Yeah.
And it's devastating. And the hardest thing for me was my job was to put together financial plans with people. And they were calling me and I was doing 6, 7 appointments a day. I was drained. Every time I was in an appointment, I could actually feel the phone on the desk vibrating and the red light of like voicemails.
Oh,
And every
geez.
appointment I had like another 10 voicemails, appointment, 10 voicemails.
Because everyone was just like freaking out,
It
and
was everyone's panicking.
yeah.
And everyone, what they were simply doing is they were taking the financial plans that we created, granted life changes, they were throwing them out the window, panicking and just begging to get out. And
And is that a common thing that I mean, you have a lot of experience. I've always been curious because I've only been investing on my own since 2014. So this is like the first major thing that's happened. Is that pretty common though? Does like just in general, do people just kind of freak out when the stock prices fall the way they did in COVID or '08? Is that always kind of been the way people react in general?
I think the answer is yes. And I think the media makes it a bit worse.
Yeah,
That kind of creates that avalanche effect. And I think what happens is there'll be the two sides, and one side will say, this is the time you got to protect, you get
yeah,
out. And the other side will say, this is the best opportunity in the world, you're going to miss it. There's always like wise minds will say that. But what
sure.
actually happens is most people are in a diversified portfolio of stocks and bonds and cash, very little cash. And the interesting thing is that bonds pay so little interest, and they were paying 5% back then. But a lot of times people were in corporate bonds. So meaning that they could actually go down, not up when the market
Oh yeah,
fell.
right.
So not only so when people's minds are like, well, oh great, well this is a great opportunity, but for most people conceptualize and say, well, I'm losing money all over the place. Where's my cash to go buy something? So
Oh, got it.
so the question is what's non-correlate, what's going to go up when the market goes down? They didn't have a lot. So that's what causes that extra panic. And I think the other challenge is any large firm where the fees are amazingly low, you have to expect that the people you're working with work with lots of people. It's just,
Yeah,
you have
it's a
to figure
numbers
out the
game,
scale.
right?
Yeah,
Yeah,
completely. It's just to make a business run. And if you're paying a lot of money, in theory, you're probably working with fewer people that are serving you. So maybe
sure.
you'll have more communication on hand holding. But to be honest, when someone's paying a fee and they're losing substantial money, there's this like click in the back of your mind. It's like, well, I don't want this anymore. And
Yeah,
that's what creates some of the selling crescendo. And then I always remember like the you watch Wall Street, the movie, and you're like, all right, fear and greed, like I hear it. Then all of a sudden you're like, it's so real. Like
yeah,
when the market's up a lot, they're like, well, why aren't I up more? And then the market's down a lot, you're like, this is awful. Get me
yeah,
out. And so it's this really interesting part of like our DNA that you can't shake because money is really emotional.
yeah, yeah. It is right.
So
Yeah,
so a quick answer is absolutely. That happens sadly every time. It happened probably to a lesser extent this past March because I don't know. Maybe it was just so fast.
yeah. It did happen
Um,
fast, I guess, right? In regards to previous declines.
yeah.
Yeah, that's interesting.
So the negative 2008 market, it kind of led me on this path where most people just kind of shake it off and they say, that's just life and give it time, whether it's like 4 years to break even or years. I mean, it could be much longer. I mean, the Great
Right.
Depression was something to the tune of 20 plus years of waiting to get back to all-time highs. So we're in this environment where I just said like, well, there's got to be a better way. Like there absolutely has to be a better way. And I conceptualized it, and I have a background in economics. I worked at Fidelity for 16 years. I was a CFP. I'm making mistakes left and right.
Yeah.
And so the things that probably people can relate to, when I first started, I chased mutual funds. There's always really good ones. Why aren't I in the best one? And then what
Yeah.
happens is you buy and it falls. It's just like this. You're always buying high. You're buying at the wrong time. I I had so many people tell me go buy dividend stocks. That it's mailbox money. It shows up quarterly in your mailbox.
Okay.
I
Yeah.
I don't know how it happened. I I bought GE. It's been around forever. I think it was called the Dividend Aristocrat, which means it's paid a dividend, increased its dividend
Yeah.
for 20 straight years,
Yeah.
25. The second I buy it, it lost 60% of its value. They actually cut the dividend.
Oh
So
yeah.
I'm sitting there,
Jeez.
I'm just like,
How?
how? So I bought the one time the Aristocrat punted.
Yeah. Yeah.
So pretty wild. So and then my third one is I was in a diversified portfolio in which in theory should have been fine. I got creamed in 2008. So I sat on this path like, well, how else can I figure this out? And financial media wasn't helping me. Twitter was just kind of getting going, not
Okay.
totally
Yeah.
helpful. And I sat there and I said, okay, well, what what can I figure out? And everything for me started. I don't know how, but I was invited to a dinner with a 230 billion dollar fund manager, and I was sitting in that dinner with about 50 people. It was totally awesome. I mean, this guy runs so much money. He Every CEO and CFO on first name basis.
Wow.
He was telling just like elegant stories of hanging out with Warren Buffett, asking really smart questions, and like every company we've all heard of, he knows them, he invests in them. It's just fascinating. But what I kind of took a step back. I looked around, and everyone in the room was just like scribbling ticker symbols down, like the
Oh, like the next
like
hot thing to buy or
yeah.
whatever.
So it's like, okay, well, Berkshire Hathaway, BRKB or BRKA. So they're writing down these symbols, and I looked around. I was like, well, how do they know he's buying, and how do they know when? And then he started listing other names, and I started thinking like, okay, well, that stock's up a ton. And he was kind of going through his top 10 holdings, and he was kind of rolling through it. And I sat there and I go, well, what if I could figure out what he was accumulating? And like, what if I could figure out, like, because his fund is so big, he can't just buy in when he wants to, like most of us can. He has to like just do a tiny chip each month. So if he
Oh.
really, really likes something,
Oh, like there's literally not enough shares outstanding potentially to like.
he would jump the price. He would double it really fast.
Got
He's
it.
Because if he wants to get to some of his largest positions are trillion or sorry, $1 billion positions.
Right.
So he's gonna have to slowly buy month after month after month. And likewise, if he's going to sell, he's going to sell month after month after month. So I just kept thinking in that dinner, how can I figure out what he's doing? And that was the crux of my business. Where
Got it.
so most people that have come to the agreement that they are done winging it, I'm going to model the best humans out there. There's a report that's legal that's called the 13F reports. And what it simply says, at the end of each quarter, you find out what they were buying and selling.
Right. Okay. Yeah, I've seen these.
So Buffett just made the news the other day where you just found out what he bought in Q3. So typically, just to make the date simple, in May you found out what he bought January through March. So it's in the neighborhood of 45 days late, possibly 4.5 months late.
Right.
I figured a way how to find a whole bunch of funds that equal about $1 trillion that report 30 days late. So I'm either 15 days or about 3 months and change, almost 4 months ahead of the curve. So I'm good at data. That's where I started my career. And I
Okay. Yeah.
scrub it, and it gives me a list of funds that voluntarily give their information faster.
Oh, so it's voluntary. It's like they only have to do it quarterly, but they're actually doing it earlier.
Correct.
And what's the incentive for them to do that?
I don't know. Maybe the compliance world loves them more. I'm not totally sure.
Interesting. Okay.
It's a good question. It's one of the reasons they don't want you to know immediately. So the world of index funds and ETFs, you know that next, like almost immediately, the next day, what's in them.
Yeah.
So
right.
A lot of these huge funds were fighting hard to do non-transparent ETFs or index funds because they don't want their secret sauce gone.
Right. Right.
So what the crux of my business, where I think my edge is, are two pieces. So the very first piece is it's like an all-star team. If you just follow one smart person, they will go in and out of favor. And we're human. And the moment they start underperforming, you're probably going to leave them. It's
Okay,
just
yeah.
so no different than when you're driving on the highway. You're in the middle lane. You're like, maybe the left lane looks like it's moving.
Yeah.
And then
Yeah.
you move over there, and then everyone else is going ahead of you. So what I figured is, you know what? I'm a relatively bright guy, but let's follow an all-star team of people doing this. The largest funds I get my hands on that report faster.
Got it. Okay.
So this is what I do. And I'd say now, will it work every time? The answer is no. That's why
Sure.
we have rules, and we have to get out at some point if something doesn't work in our way. But it's providing a level of confidence that I personally was dying for. So when the times are bad, you can hold on to something because you know that they're still buying.
Yeah.
Or
Okay.
so I have 3 rules in my process. Rule number 1 is buy what billion-dollar fund managers are buying. And if you do that,
Yeah, make sure you're not buying things that they're not buying too, right?
yeah, that's rule number 2.
Okay.
If they're
Okay. There we go.
selling, you need to get out,
Yeah.
because it is an ugly chart. It's a huge, just a downdraft. Because when they're going to get out, sometimes they'll get out fast and they'll just crush. When you see sometimes a stock just gaps down
Yeah.
20% and you have
Yeah.
that stomach wrenching feeling,
Sure. Yeah.
that's typically one of the funds jumping out.
Oh,
That's not a
okay.
bunch of people at Fidelity, Schwab, Robinhood. That has nothing to do with them typically. This is a
It's
huge block of shares disappearing and being thrown out into the marketplace.
Oh, is it really? Okay. That makes sense. I mean, that makes a lot more sense than the latter. Okay. I didn't know that for sure. I kind of figured that that was what was happening because does seem like sometimes especially during COVID, like some of the increases and decreases we've seen just almost seem like unnatural in regard to, like, at least for me, I mean, the few years I've been, trading before that, it seemed extra crazy.
Yeah, and I think, well, when the bond market gets crazy, the Fed helps.
Okay.
So the Fed
Right.
provides liquidity, but when the bond market panics, stock market totally panics.
Oh,
Is it?
okay.
So it's because the bond market's 3 times the size of the stock market. I always think of when
I didn't
you
know that the bond market's 3 times the size of the stock market.
enormous.
Oh, I didn't know that.
That's why the U.S. dollar is the world's currency. It's just the treasury market's so liquid.
Oh, wow.
So, so if you're going to be moving money around, that's part of it.
Okay.
But it's
Got it.
interesting. When I used to years ago, I used to Fidelity. They love education. They would send me, and I'd listen to a fund manager talk, and I listened to a bond manager talk. Stock managers are so fun to listen to. Bond managers, no offense to any bond managers, it's really boring. And because winning means you don't lose. There is no real
Oh,
winning. You just get the
right.
yield off the bond.
Yes, right.
The most boring thing in the whole world is listening to a money market or a cash fund manager talk. It can't get any worse. It really can't. You'll actually see the room full of people that are watching and listening to these people talk quarterly. You actually see everyone leave
Wow, really?
before the money market manager gets on because it's that boring.
Oh, that's a bummer. What a rough job to have then.
But there's a lot of money in
Yeah,
cash, so
right.
it's
Yeah.
lucrative, but
Yeah.
it's boring.
Got it. Okay. Okay. So those first two rules make sense. And then what did you say the third one?
So the third one is what I call invest with the trend. And we just witnessed it in March. The market has a way where sometimes the greatest stocks, the funds that are accumulating, can get thrown out as well during horrible times, just like
Okay.
what we saw.
Right.
So if I go back to rule 1 and 2, and I go back to why this is different than 13F reports. So when you only know at the end of each quarter, 45 days later, you're just late, is just the reality of it. It's hard to follow someone short term just to know what they're really doing.
Sure.
But the thing that I started noticing is the funds were selling hotels, airlines, energy. January, February, March, just gutted them.
Yeah.
That's
Right.
where we saw that. Where they were moving was January, they were kind of bashful, but they were going to healthcare. Um,
Okay. Oh, were they really? Yeah.
so one of my stock of the month reports that I sent out was just Regeneron.
Yeah.
Do I know they were going to happen to have some sort of a cocktail that was really help the president? We have no idea, but they were buying healthcare stocks. And then I saw them buying heavily in February and March and pretty much on through stay-at-home tech.
Yeah.
And I don't know if I picked the right one out of a basket, because there's typically in my world, I look at about 25 to 30 stocks, and I don't know why I committed myself to give one away for free once a month.
Okay.
So I'm
Yeah.
picking out of a basket. Sometimes I pick the right one, sometimes I don't. But I picked Slack. I think it was up 60%.
Yeah.
It could, I mean, it maybe wasn't the true Zoom of the world. The next month I picked DocuSign, so that was much
It's a
better,
good one.
up 200%.
Right.
So stay at home tech, and then all of a sudden again, you start watching them, these large funds go a little bit away from they take profits on their stay-at-home tech. And what's fascinating is they start to go to places that you wouldn't expect. So you're like, huh, they're starting to look at electric vehicles. They're starting to look at maybe there is a Democratic presidential win and they're looking for some sort of cleaner energy solutions. Maybe, we don't know. I started to see like some travel companies show up. I started to see some hotel companies show up. I started to see more sports betting. I started to see a lot of interesting trends where you're like, maybe they think the worst is maybe
Is
through.
past. Yeah.
So that helps me. But the answer to your question on rule number 3, invest with the trend, is the when is the hardest part for absolutely anybody. So if we know what to buy and sell, what with confidence is really dangerous. But the when to me was always, I have to figure this out. Like I have to figure out like when is it right to time, when should you protect your portfolio? Like when should you maybe go all in? Like
Yeah.
when do you put it all together? And I couldn't figure it out. I read probably dozens of books. The thing that actually helped me the most was my old company had a report called the performance report. And if you're a client of that company, every month, a few days later, you get how you did last month and how you did for the year. They track you really closely.
Okay.
And every rep gets it, and every rep's honestly too busy. And I think they stopped giving it out because no one ever, they probably looked at the open rates like
And no one
0%.
was. Yeah.
I loved it. I thought it was really fun. What most people did who opened it, they would look at it and they would call the people with the worst performance, get them in, help them, which makes sense. They're struggling.
Yeah.
What I did by accident is I double clicked it and it somehow posted best return to worst return. And there were people in my book, some were fund managers, hedge fund managers, everyday people, business owners, but there were some people who were just crushing it. And
Interesting.
I have nothing to sell them because there's nothing on earth that I had that could match their performance. It's just the
Okay.
reality of how good they did. They sidestepped 2008.
Yeah.
So I sat down with no intention, just asked them questions. And I learned that some of them just happened to work for companies where their stock was just on fire.
Okay.
So they just they had corporate, like C-suite, CFO, CEO, just had huge share accumulation and the stock just ripped. But a lot of the time, there were these people that they couldn't really verbalize what they were always doing, but they would look at my screen, they'd pull it towards them in my
Yeah.
office, and they would point on a chart and say, "This is where I get in, this is where I get out." And sometimes it was technical, sometimes it was fundamental, meaning it was based on the balance sheet, sometimes it was based upon a chart. But I kept watching interview after interview after interview over a few years of them just pointing at my chart, at my screen, and my charts, and I'd be like, "Huh, like there's a bunch of commonality that I keep witnessing of like, okay, well, they were kind of buying here, here, and here, and they were selling here, here, and here." And I was like, well, what if I could kind of not program it, but what if I could say, okay, well, this is where they probably would have sold
Sure.
based
Yeah.
upon what they've consistently kept telling me. Long story short, I took a fraction of what they gave me because I was kind of scared, and I gave it to a professional back tester, and I was like, huh, that worked incredibly well. It's nothing's perfect,
Right.
um, but it gives me these little signs that say, hey, something's popping up. And I run the report once a week. A really good example, I sometimes time my weekly articles to things that are breaking out or
Okay.
popping up on my screen. So sometimes my timing's pretty solid and sometimes it's rough, but marijuana stocks 3 weeks ago, it was breaking out that the program said, hey, take a look.
Yeah.
So same with sports betting stocks, same with a whole bunch of other small little micro trends, but I try to produce content based upon these little alerts.
Mm.
So
And
it's not just me.
these alerts are coming from is it software or modeling that you're doing?
It is. It's
Yeah.
exactly right.
Okay.
So the biggest problem with any modeling, nothing's perfect, is you could suffer what's called whipsaw, which is it gives you a buy signal and then it turns around and gives you a sell signal. I tend to have a program that gives me multiple buy signals. So it kind of increases in confidence and decreases. So rule number 3, invest with the trend, is what I always wanted for all these years, is just for someone to say, just stay put. Just
Mm.
just
Yeah. Okay.
get out of your head.
Sure.
Or someone to say, you've got so much cash, it's time to deploy some. Just do a little bit.
Yeah.
So, and in today's world of zero commissions, that was what I always needed. So that's something that I run. So how it works in my business. So for free, I kind of write a 5-minute or less article. At the bottom of the article, I give that model stage, the rule number 3 trend of US stocks, foreign stocks, US bonds, and gold. I do 4 because I think most people own that to a degree.
Okay. Yeah.
And then once a month, I've been delivering one stock that fund managers are buying.
Got it. Okay. And that, so you're using, yeah. So you're using that first part you talked about, and then kind of picking one out of the conglomerate of the companies that are sharing out, early buy sell positions, and sharing one of those out with your audience a month.
Correct.
Got
Yeah.
it.
So that's what I deliver for free. And everything's subject to change. As I
Yeah.
love feedback. But so far I've had some, there's nothing better than getting an email saying like, that was totally awesome and totally helpful.
Right. Right.
And
Right.
then from there, there's more, there's a premium version, as well, but that's
Oh,
something
okay.
where, I want to deliver an awful lot. So there's hopefully, people get a lot of value.
Yeah, no, I love that. I will obviously link the link to the website in the show notes, and we can share that out. I think it's really cool. Before this, obviously, this is our first time chatting, so I didn't get to understand the back end of it, but I do definitely agree. I think it's funny, and obviously you do this professionally. All my friends, family, listeners that I've talked to, I would say like the most common thing I hear is I run into way too many people who are trading on the news. Like they see something in the news, they jump on it. And to your point, I can only imagine that when that happens at scale, retail investors are the ones losing. The institutions that are doing the big moves are the ones that are making the money, right? And so this is really interesting. It's a really interesting topic and concept. How how then, I'm just so we all know, because I think a lot of people I'm sure will sign up from hearing this, what is going to be different or added on the premium content side of the platform you're building?
I think what I always wanted from somebody, I read a lot of books. I joined some newsletters. I just love to learn.
Yeah,
I
same.
like to learn what I wasn't getting at work also.
Okay.
And my belief system is that if you are going to be in a diversified portfolio, of index funds, I think in the long run you'll do fine. I just think that we're human and there's a chance you could sell at the worst point. And the hard part is I don't know if you'll do as well as you used to be able to do. Meaning that stocks are more expensive now, bonds are yielding less now. But the premium version, what I always wanted was someone to just kind of open their portfolio to me. So what do you own?
Oh, yeah.
Um,
Okay.
so number one, it's more transparent. Number two, um, the biggest thing I think was I always like a lazy man portfolio, or so just like a very few positions, but they're
Oh, yeah.
diversified, like a basket of an ETF, more than just individual stocks. So using the model on using index funds, using the model.
Yeah.
So having a transparent portfolio. And I think for some people that do get that itch to be a little bit more active, having someone give you setups, that are, it's so easy to buy everything that's already high, like these
Yeah.
breakouts. But what's really interesting is when things are, I love when things are beaten up, and they're turning. So they're improving and they're beaten up. So a good example, whether we want to, I mean, at some point we knew vaccines were coming at some point.
Sure.
We
Yeah,
just
yeah,
didn't
yeah.
know when. I mean, we're being kind of
Or like
held over our
which
head with a
company
carrot
or anything, right? I think
for,
that's, sorry, go
yeah.
ahead. Yeah.
No, so let's take like the Shane index. There's a
Sure. Oh, yeah,
couple
there
of
we go.
stocks in the Shane index, which I really like, that you had some energy plays, you had some Um, you had a couple plays that were just perfectly set up. Just the storyline changed,
Yeah.
and the story went from tech bull run
Mm-hmm.
to, over the last few weeks, you've seen a shift where that storyline is still great. They're still making tons of money, but everyone's already there. So
Yeah.
where people weren't was small caps, international, and then areas that got killed. So like energy, as an example, is a really good example of a place where no one wanted to be. People think that, I mean, you turn on CNBC, and I don't watch too often, but I heard Kramer say, like, I don't recommend any stocks in energy right now. That's like, you should perk up when you hear, I don't recommend any. Like, if you say, I don't like this sector or this area at all,
Yeah.
you're close. You're close. You're close to the bottom. Like, you're right there. So
Yeah.
I think those are the times you like, you play the opposite game, and you kind of sit forward and you go, oh, like, this is probably, the model's probably going to tell me. So I run the model based upon 100 different areas of the world and the
Okay.
markets. And it just says, like, hey, heads up.
Wow, that's really
So
cool.
yeah, so that's kind of something that I will certainly deliver. And then last but not least, I think people have questions now, because I'm not acting in the capacity that I used to act in, where I'm giving more generalized advice.
Sure.
Not always talk to your financial advisor and always kind of back check it, but I'm giving you kind of what, from a different perspective, that I believe would be really helpful, but it needs to be coherent with what you want to do with your life.
Right, right. Yeah, it makes sense. Um, no, this sounds really interesting, and it sounds like something you've been working on for a long time. I think this is extremely interesting. I think in today's world, personally, um, we're just bombarded with so much information. What I always respect is hearing someone like you that's created something that uses data. And I think a lot of people who are just getting into investing and are getting into the Robinhoods, which, I mean, I use Robinhood, but if you're someone who just got in, is using Robinhood and has MSNBC on one screen all day while you're working from home, I just think you can get really sucked into, for better or for worse, just a lot, to your point, a lot of, I mean, they're trying to get headlines, they're trying to get sound bites, they're trying to kind of just like have something exciting to talk about all day every day. That's not great financial advice, and a lot of times it's not using data, right? And I think what you're building sounds like it's very analytically driven, and it sounds like it has a ton of value for people.
That is the hope. I think for me, so when I watch CNBC, I don't, or Bloomberg or Fox News or
Sure.
whichever is on the screen, you just don't really know. Sometimes it says in really tiny font, like, holds this position, but
Right.
you don't know if they're buying, and you don't know if they're selling. They could very easily bring something up and sell into it.
Yeah. Right.
It's so easy for them to do that.
Yeah.
And there's that's fine. I mean, there's nothing wrong with what that is. It's just, so I think that we're all subject and sucked into a really good story. And I think sometimes story investing is really good, but what if your story's wrong? So
Yeah.
like what if they're not buying? Like, and then, I mean, it happens to me still. We're humanly trained, we're biologically trained to do confirmation bias. We want to, whatever we own, we try to go read good stories about it. So the question is okay, well, am I wrong? And
Right.
if I am wrong, what's my exit strategy? Because
Sure.
at zero commissions, so what? Just move along.
Right. Yeah, no, that makes sense. It's true. And people are learning that way. No, this sounds awesome. Scott, thank you so much. I think I have a couple last questions I'd love to ask you. Especially someone being in the investment space for so long. It's not, I'm sure you've had to handle, handling clients. Now it's starting a business and running, this whole different side of finance. Do you have any tools that you like to use on a, basically anything, whether it's apps, even just pen, paper, how do you like think about your goals and break them down into like daily tasks or like weekly tasks? Would love to just understand your perspective on that.
Um, that's a good timing as we approach the end of the year.
Right.
Yeah, things that I found really, really helpful. Years ago, I read the book, Living Forward
Okay.
by Michael Hyatt and somebody else, someone with an H. Excellent book. So my thing that really helped me, I put my head down, worked really hard in corporate America, and I didn't pick it up very often, except for my wife and my family.
Yeah.
But I really type A, you just kind of work, work, work. And by taking a step back and jotting out like what's really, really important to you and where's my time going to go? For me, it was family, it was health, it was you can't do it now, but it was like try to do some travel, at least travel to see family. So
Sure.
having
Yeah.
a lot of it documented of what's really, really important. And then I think I also did. It was almost it was so inexpensive considering the value I got. Famous author Donald Miller. It was like a life planning course for almost nothing. And again, it just kind of helped organize what you really want. Because if you don't know what you want, it's unfortunately someone else is going to dictate what you want,
Yeah. Love that.
which is part of it. And then they always had kind of focus on, they gave you kind of a to-do list of 3 things. And if you did it, how would you feel? And so there's a little worksheet that you fill out. As an entrepreneur, that to-do list is long. It's never shortened. So I imagine
Sure.
as you're working, putting on this podcast, it's a long to-do list.
Yeah.
But I try my best to I have goals for today. I have goals for this week. I have goals for this month. And if I don't accomplish them all, unfortunately, they get pushed a little bit. But it's all structured, typically written down. I was using Google Docs for ages. I use it for a lot of personal finance and other things. But I think writing it down
Yeah.
is an exercise that's really helpful. Do
Yeah.
you find the same thing, or is
I
that
do.
different?
Yeah. I've, I feel like it's funny over the last couple of years. I've tried like every app. I've tried, just regular pen and paper. I'm now using, actually, it's funny you said Michael Hyatt. I use his full focus planner. I don't know if you've ever heard of
Cool.
that.
Yeah.
Yeah. So that's what I've been using lately. There's something about writing it down on paper though, for me. Um, it's totally different than anything else. The only thing that's tough is it works well for me now being in the work from home environment. When I was on the go all the time, the only thing that didn't do is if you forgot it and it was like your to-do list or your plan for the week. So you got to make sure you can keep it on you a lot of the time. I noticed that was important. But yeah, I've seen a whole change specifically in 2020 for me on writing things down and having a goal with weekly plans and daily plans that builds to that. That's something I've actually learned a lot from Michael Hyatt, is just, that whole concept of, if you don't know what you're striving towards, you're going to end up where you don't know where you're going to end up. Right. You're just you're headed to a place you don't know where the finish line is. And then B, if you're not planning your time, someone else plans it for you. So I like that all with paper and pen. That's the way I've been able to accomplish a lot of things this year.
That's a good point.
Um, The next one is, do you have a favorite book that you commonly recommend to people? It can be any background. It doesn't have to be finance necessarily, but just curious if you have a book that you love to gift to people.
Yeah, that one I just mentioned is excellent. That was Living Forward. I've actually mentioned that several times recently as we
Okay.
approach the end of the year. And I'd say I tend to go 2 different directions. So I have readers and friends who are like devout value investors. So I'll go finance because that's I've talked about the whole day.
Sure.
So who are devout value investors, and nothing gets them more excited than a boring company at half off. So Benjamin Graham, intelligent investor, by far and away,
Yeah.
it's their start. And then for me personally, I tend to be more of a growth investor. I don't know, it's more exciting to me. So I like, if I miss out on a stock's 50 or 100% run, but there's still another 500 to go. That's William O'Neill and How to Make Money in Stocks.
Okay.
So that book, I probably, it's on everyone's mind. So when everyone kind of looks at like the Amazon example or
Sure.
the Google example, and they're like, well, could you have handled multiple 80% drawdowns? And most people can't. But there's a recipe that all of these growth stocks have, and they have similar commonalities. And I think that that How to Make Money in Stocks with Bill O'Neill, it's a recipe for finding the most exciting, maybe not just stocks, but the most exciting companies that are coming and already out. And I think that's a book that I've typically given out.
Cool. That's awesome. Yeah, that's a great one. I'll add a link to that in the show notes as well. Um, and then yeah, the last one really, obviously we've mentioned it's investwithrules.com is the website. People can sign up for the newsletter on there, right?
You can. Yep.
Yeah. Is there any other place that you're putting out content that people should follow you that you like to share, or is it really just go to investwithrules.com and that's the best place to go?
Yeah, absolutely best place. So investwithrules.com. If you sign up first name and email, you'll be on the list to just get free content that's highly valuable. I will not waste your time. Um, on there, if you want to really click around a bunch, I put the most downloaded article on a kind of a popular blog page if you kind of click around. So I put some stuff up there, and I typically will kind of put out on social media, just kind of leading you back to, I don't know, it's free. It's, in my
Yeah,
opinion, it's super valuable and it's free. I'm not asking that much from you.
for sure.
So if it's not for you, it will break my heart a little bit, but I understand. But I give away a lot for free because I want to provide the value to you.
That's awesome. That's awesome. Well, Scott, thank you so much for coming on. This has been a blast. I'll definitely, obviously, like I said, share this out, and hopefully, we'll get some new readers of the website. And I wish you the best with your new venture, and hope the growth comes. And it's I'm excited to see what it turns into.
Awesome. And Shane, thank you. I've been listening to your podcast too. So you've got some
Well,
excellent
thank you.
content.
Appreciate
And
it.
I wish you and your family a happy Thanksgiving, happy holidays, and look forward to connecting again soon.
Yeah, let's do it. Happy Thanksgiving. Hope you guys stay healthy and safe, and we'll come back and do another one.
Sounds great. Look forward to
Awesome.
it.
Sounds good.
Thanks.
Thanks, Scott. I appreciate it.